Hi students, welcome to the Smart Commerce channel. In this episode, we will study the rules of debit and credit in accounting. Before going to the rules of debit and credit, we want to see what is an account. An account is a statement of transactions. An account is a statement of recorded transactions taken place in an organization. Now, types of accounts. According to traditional approach, accounts are of three types. They are number 1, personal accounts, number 2, real accounts, number 3, nominal accounts. Number 1, it is personal accounts. Personal accounts are accounts of persons, both natural persons and artificial persons like entities or firms. For example, Mr. A's account, Mrs. B's account, AB and company account, etc. The second type of accounts, it is real accounts. Real accounts are accounts of assets. For example, cash account, furniture account, plant and machinery account, etc. Third, it is nominal accounts. Nominal accounts are accounts of expenses and incomes. For example, wages account, salary account, commission received account, etc. Let's discuss the rules for determining the debit and credit accounts, that is, the receiving and giving aspects in a transaction. First, it is the debit credit rule for personal accounts. The rule it is debit the receiver and credit the giver. കിട്ടുന്ന ആളിനെ ഡെബിറ്റ് ചെയ്യുക, കൊടുക്കുന്ന ആളിനെ ക്രെഡിറ്റ് ചെയ്യുക. For example, paid cash to Mr. A. When we, the firm, paid cash to Mr. A, then Mr. A is the receiver of the cash here. Therefore, Mr. A's account is to be debit or given debit. That is, Mr. A's account is the debit account here in this transaction. Another example, received cash from Mrs. B. When we receive cash from Mrs. B, then Mrs. B is the giver of the cash here. Therefore, Mrs. B's account is the credit account here in this transaction. Next, it is rule for the real accounts. The rule for the real accounts is debit what comes in and credit what goes out. വരുന്നതിനെ ഡെബിറ്റ് ചെയ്യുക, പോകുന്നതിനെ ക്രെഡിറ്റ് ചെയ്യുക. In the above example, when the firm pays cash to Mr. A, cash goes out from the firm. Therefore, cash account is the credit account here in the transaction. When the firm receives cash from Mrs. B, cash comes into the firm. Therefore, cash account is the debit account in the transaction. Now, third, it is rule for the nominal accounts. The debit credit rule for the nominal accounts is debit all expenses and losses and credit all incomes and gains. ചിലവുകളെയും നഷ്ടങ്ങളെയും ഡെബിറ്റ് ചെയ്യുക, വരവുകളെയും ലാഭങ്ങളെയും ക്രെഡിറ്റ് ചെയ്യുക. For example, paid salary. When the firm pays salary to the employees, then salary is an expense to the firm. Therefore, salary account is the debit account in the transaction. Another example, commission received. When the firm receives commission, commission is an income to the firm. Therefore, commission account is given credit in the transaction. These rules of debit and credit for personal accounts, real accounts and nominal accounts according to the traditional approach is popularly known as the golden rules of accounting. Next, it is modern approach. According to the modern approach, accounts are of 5 types. They are number 1, accounts of assets, number 2, accounts of liabilities, number 3, accounts of capital, number 4, accounts of expenses, and number 5, accounts of incomes. Now, the rules of debit and credit. First, it is the rule of debit and credit for accounts of assets. The rule it is debit means increase and credit means decrease. Means that when the value of an asset in the firm is increased through a particular transaction, then that particular asset account is to be given debit. If the value of an asset is decreased through a transaction, then the account of that particular asset is credit in the transaction. Second, it is accounts of liabilities. The rule it is debit means decrease and credit means increase. Means that when the amount of a liability is decreased through a transaction, then the account of that particular liability is the debit account in the transaction. And if the amount of a liability is increased, then the account of that liability is given credit in the transaction. Now the third, it is accounts of capital. The rule it is debit means decrease and credit means increase. Means that when the amount of capital in the firm is decreased, the capital account is debit, and if the amount of capital is increased, then the capital account is credit. Fourth, it is accounts of expenses. The rule is debit means increase, credit means decrease. When the amount of a particular expense is increased or a particular expense is incurred, the account of that particular expense is debit, and vice versa. Now the last is accounts of incomes. The rule is debit means decrease, credit means increase. When the amount of a particular income is increased, that is a particular income is earned, then the account of that particular income is to be credit and vice versa. We will be back soon with the next episode of the class. Thank you. For the easy access of the classes, please subscribe the channel. It is free by clicking the subscribe option, and for getting notifications, click the bell icon below.